Hi, and welcome to Chapter 19, International Managerial Finance. This is our last chapter in this course, and in this chapter we're going to talk about and try to understand the major factors that influence financial operations of multinational companies, otherwise known as MNCs. We're going to describe the difference between the purely domestic and international financial statements, consolidations, transactions of individual accounts, and international profits. We're going to discuss the exchange rate risk and political risk and explain how to best manage those risks. We're going to talk about foreign direct investment, cash flows, and financial decisions, specifically about capital structure and international debt and equity instruments available to these companies. We're going to talk about the euro currency market, short-term borrowing and investing in different currencies, the basics of international cash and credit and inventory management, review joint recent trends in international mergers and joint ventures, something we touched upon last chapter. So what is a multinational company? Well, it's a firm that has assets and operations in many different countries. So it could be as few as 2 countries or as many as 30, 40, 70, 100 countries. So if you look at a company like McDonald's or Coca-Cola, they operate in over 100 different countries. So they face, you can understand that each country has their own regulations. A lot of them have different currencies, different political structures, different laws. So the multinational is going to face many different laws and restrictions when operating in all these different nation states. So the legal and economic complexities existing in environments are significantly different between domestic only companies would face, and thereby significantly raises the costs of becoming a multinational company because of all these other different regulations and issues that you have to worry about. Now let's look at some factors and the difference between a domestic and a international company. So foreign ownership. Domestic companies, all assets are owned by some sort of domestic entity. In a multinational, portions of foreign investments are owned by foreign partners or shareholders, and those are going to affect, so decisions will be affected by these foreign partners. Multinational capital markets, so for domestic companies, all debt and equity structures are based primarily on domestic capital markets. But international companies, the opportunities and challenges are many, and they can access many different capital markets throughout the world, which they can raise debt and equity. Multinational accounting. So domestic firms have a pretty easy time consolidating financial statements based on one currency and one set of accounting principles. But if you're going to be a multinational, different countries and specific translation rules influence how the financial statements can be consolidated into one country. Foreign exchange risk. For domestic companies, all operations are in one currency, which makes things very simple. But in international companies, fluctuations in foreign exchange markets can affect foreign revenues and profits as currencies float against one another and change the value of money when it's transferred between different currencies. Okay, so diversifying operations. So one of the reasons why firms have operations in foreign markets is that this portfolio concept we discussed in Chapter 8, we want to spread our risks around. So it's not wise to have your company have one headquarters and manufacturing site in just one part of the world. So even, you may have companies like Amazon, which is establishing 2 headquarters in the United States and has operations all throughout the world. Now, if you're a company like Coca-Cola, you'll have manufacturing or bottling facilities of partners throughout the world as well, because it doesn't make sense to bottle all your product. Remember, water is heavy, so it makes no sense to bottle it all in the United States and ship it across the world. It makes much more sense to have production facilities in every country or local market and use the local water and just transport or the syrup. So having operations in many markets can help smooth out some of the cyclical changes that may occur in each of the different markets, and just give the company a better overall guidance or control on how they manage such a large multinational outfit. So now, if your company is going to be operating internationally, there are many different trade blocks that companies should be aware of. One of the biggest ones is NAFTA. So NAFTA has been around since the 1990s. Even though it's open for renegotiations and rediscussions, it's still a very large free trade environment that's a treaty between Canada, Mexico, and the United States. So this is a large agreement that covers many different industries and products. And one of the reasons they want to renegotiate is because there are some new products or some new technologies or some new business concerns that weren't even born back when NAFTA was first created. But the idea of creating NAFTA is to make trade more free in a particular area, such as North America. And this should make it easier for companies to utilize the resources and advantages of all areas in the free trade zone to freely move their products between countries and not worry about local laws or regulations getting in the way of operating within this trade bloc. And NAFTA has been one of the largest and most successful trading blocs and has facilitated Mexico and Canada becoming two of our largest trading partners. Now, there's also a Central American Free Trade Agreement, and this agreement was signed in the 2000s, and it includes the United States, Dominican Republic, and 5 other Central American countries: Costa Rica, El Salvador, Guatemala, Honduras, and Nicaragua. So this extends our free trade agreement throughout Central America. And it's helpful, like we said before, for American companies to have less regulation, less paperwork, and less worries when they operate within another country within a free trade agreement. So they don't have to worry about the foreign country establishing tariffs or roadblocks or special regulations that could impede their business. Now, of course, another famous trading bloc is the European Union. That's made up of it does fluctuate depending on the particular point in time, but 27 nations, plus or minus England, depending on when Brexit is finished, that permit free trade within this union. So the European Union is an open market that has evolved over various different states in time. So since the 1990s, Europe has been moving to closer and closer integration to facilitate trade, employment, and make the continent more efficient for doing business. And it has worked. It has been, we have seen the growth of Eurozone gross national products increasing as the free trade bloc has been very beneficial to many countries. And one particular country, Ireland, has, due to their low tax rate and entry into the EU, is a point for a lot of American companies to establish a headquarters or presence in Ireland to gain access to the EU trading bloc. So part of the EU integration, the euro was created in 1999 as a separate single currency, which greatly enabled the European Union and their trading bloc to be more efficient, eliminating multiple currencies in the area and making it much easier for their citizens and their businesses to make trade without worrying of foreign currency transactions or foreign currency loss while selling products or moving between different countries. It also made it much easier for tourists to visit Europe and carry a single currency rather than multiple currencies. Now, the monetary union is the official melding of all the national currencies of the EU into one currency, the euro, which began in January 1st, 2002. Now, what's interesting is that not all countries in Europe have the euro. So if you go to, say, the Scandinavian countries like Denmark, Sweden, Norway, they have separate currencies. If you go to England, they still have the British pound. So not all countries use the euro. But you take a country like Denmark, their currency the crown is pegged to the euro. So essentially, it's stabilized currency which keeps the exchange rate equal to the value of the euro, say, against the dollar. Now, there's also a South American trading bloc that includes most of the countries within South America. There is a large Asian, Southeast Asian trading bloc, and China joined this bloc in 2010. And the South is called the Association of Southeast Asian Nations. And the TPP, Trans-Pacific Pact, is another trading bloc that is being currently worked on that has been controversial since President Trump has pulled the U.S. out of that new trading bloc. Now, when we talk about multinational companies and its environment, we need to talk about generally agreed upon trade and tariffs, GATT, and WTO, the World Trade Organization. So the General Agreement on Tariffs and Trade, this is a treaty that governs world trade throughout most of the world and extends the free trading rules to a broad areas of economic activity that's policed through the World Trade Organization. So most countries belong to the World Trade Organization. There are a few that have applied or still waiting to get in, but if you're any country that wants to do business in the world, you want to belong to the World Trade Organization. And once China was accepted into the World Trade Organization, their economy really expanded. Because the World Trade Organization is sort of this international body that's going to facilitate world trade. They're going to police policies and trading practices and mediate disputes among the member countries. So if one country does something that another country doesn't like, they have a body that can help. They can go to review the situation, post reviews, and enforce fair trade practices. Now, the multinational company and the environment. So we talk about legal forms of business organizations. So many countries outside the United States operating in foreign businesses as a subsidiary or affiliate can take two forms, both similar to the U.S. corporation. So in the German-speaking nations, which there are a few, the two forms are AG and GmbH. And many other countries, similar forms such as SA and SARL are all similar to U.S. corporations, where they create an artificial person and a shielded business entity from the individual owners being sued or liable for the company's products or business practices. Now, a joint venture can be a partnership between two different companies. So instead of having instead of trying to develop your own international business, you may want to partner with another country and make an agreed upon joint venture, basically sort of starting a separate company that two companies are contributing to. And this separate company is going to get the special abilities and information and resources of each of the two or more companies that create the joint venture. So say, for example, you want to do business in China, and it's very difficult to possibly for a American company to get themselves established and navigate the Chinese political and business environment. They may want to partner with a Chinese company that is affiliated with the government to streamline and help encourage the growth and establishment of this new joint venture. So you have the support of both governments that will greatly cut down on the red tape to bring this business together. So joint ventures, because joint ventures are two companies or more coming together, laws and restrictions have implications to the operations of these foreign-based subsidiaries. So majority foreign ownership, that could result in a substantial degree of management control by the host country's participants. So if you form a joint venture that's majority ownership is foreign, that's going to give them more power in making decisions about the company. So foreign ownership may result in disagreements among the partners on, how to distribute the product, where to make the product, how to reinvest the profits. So it does make doing business more complicated because you have more partners now. And it's also, we have to talk about the remittance of profits. Where do the profits go? Do they stay in the host country? Do they go back to the joint venture company's country, the partner that's outside the country? Do these all need to be locked down in some sort of agreement before the joint venture starts? So the more companies can think about and document how the company is going to operate and answer these questions before the joint venture starts, the easier it will be to manage and move the company forward. So if you're operating in a less developed country, the joint venture agreements can have a huge benefit in reducing the political risks for some of the countries that are less stable. And that's one of the reasons that, besides the ease of doing business, but also you're reducing the risks. Especially if you're joint venturing with a company that's affiliated with the foreign government. So they'll have more incentive to speed up the process and cut down on the red tape to get these joint ventures established. So multinational companies, unlike domestic firms, have financial obligations in foreign countries. So if you're going to operate in a foreign country and make profits in the foreign country, you have to pay foreign taxes. So there's going to be international taxation, which is a very complex issue because national governments follow a huge, diverse variety of tax laws and practice. So in summary, U.S.-based multinationals have to take into account several factors. Multinationals need to examine the level of foreign taxes. They have to question the definition of what's taxable income, and they have to abide by existing tax agreements between the United States and other governments that can influence the total tax bill of the parent multinationals, but also international operations and financial activities. And again, one of the reasons that Ireland was so popular is because their tax rate was one of the lowest corporate tax rates. So many American companies wanted to establish their businesses there to enjoy that lower tax rate and didn't want to bring those profits back to the United States, which have a higher tax rate. One of the factors in the current discussions of reworking our tax plan. We've had companies try to escape the American taxation, such as when Burger King and Tim Horton merged, and they decided to leave the United States behind as the host country and become a Canadian company. So Burger King became a Canadian company to pay less taxes in Canada, then remain an American company, and they facilitated this through I guess basically the way you would look at it is Tim Horton purchased Burger King. Okay. So in general practice, U.S. government claims jurisdiction over all income of any multinational company that's a U.S.-based company. So if income is earned by U.S.-based companies anywhere else in the world, the U.S. government wants these companies to pay tax on it. Individually, too, if you earn money outside of the United States by working in a foreign country, you have to pay domestic tax on that money you earn in a foreign country, even though your job and the profits, the income you made, have nothing to do with the United States or United States companies. However, it is possible for multinational companies to take foreign income taxes as direct credit against U.S. tax liability, and you can also do this as an individual. So if you're paying foreign taxes, you can use that as a deduction on your domestic taxes. So let's look at this example to illustrate this. So American Enterprise is a U.S.-based multinational that manufactures heavy machinery in a foreign subsidiary that earns $100,000 before local taxes. All of the after-tax funds are available to the parent in the form of dividends. The application taxes consist of 35% foreign income tax rate and a foreign dividend withholding tax of 10%, and a U.S. Rate of tax of 34%. So you get your subsidiary income of 100,000. First, you pay the foreign tax on it, which leaves a $65,000 dividend to be declared. Then the foreign dividend withholding tax of 10% is paid. So then the multinational's receipt of dividends is going to be 58,500 out of that 100,000. Now, using the so-called grossing up procedure, the multinational will add the full before tax subsidiaries income to its total taxable income. So if we look at the additional multinational income, the U.S. tax liability would be 34,000. The total foreign taxes paid as a credit are 41,000. So since the foreign taxes are larger than the U.S. taxes due are zero. So there are no taxes due because we paid more in foreign tax than we did in domestic tax. And that's why the tax credit is used. Okay. Now, because the U.S. tax liability is less than the total taxes paid, which is not too common because generally the U.S. has a higher tax rate. But if it does happen, you don't have to pay any tax because this is how we avoid a double taxation, which wouldn't be fair. So you would only pay taxes on the money, on the liability above what you paid in the foreign taxes. So the foreign taxes become a credit that you can apply against the American taxes. So now if we look at it, look at the situation from top to bottom again. So we have the income from the foreign subsidiary. Foreign taxes paid, remaining is a dividend. Foreign dividend withholding tax, and this is a tax that is, a foreign tax. That leaves the receipt of the receipt of 58,000. If we look at the U.S. tax liability of 34,000, that would make net funds available to the parent of 38,610. So this would be if you weren't allowed to. This would be the double taxation if you weren't allowed to use the tax credits of the foreign taxes paid. Now and you can see how that really, whittles away the profits. That's why it's good that over here you're allowed to use the foreign tax credit to reduce your U.S. taxes. And if we didn't have the foreign tax credit, we'd get this double taxation, which really is almost a 62% tax, which is just not fair. Okay, the multinational companies and the environment of the financial markets. We have something called the Euro market, and this is the international financial market that provides borrowing and lending currencies outside their own country. So in the Euro market, dollars can be traded in the Euro market. So it's not trading euros. So you might have a foreign country, and in the example down here, they're talking about the growth of the Euro market. And one thing they said, there are countries like Russia and Iran that need to work with dollars, because the dollar is the de facto world currency, and oil specifically is traded only in dollars. So other world powers can accumulate or have the need to use dollars. So dollars are scattered around the world. So if these specific countries like Iran and Russia don't want to have U.S. interference and want to stay out of the U.S. banking system and U.S. regulations, they can trade their dollars in the Euro market, escaping the regulations and controls of the U.S. government and its treasury by utilizing an outside the country capital market like the Euro markets to trade dollars. Now the Euro markets can also trade other currencies like the pounds, and it's just a facilitation of a financial market, and currencies from different countries are what they trade back and forth and set their prices as. Now, offshore centers, and these are certain city-states. These include London, Singapore, Bahrain, Nassau, Hong Kong, and Luxembourg, which have achieved a prominence in major centers of Euro market business. So the ability of communication and transportation facilities, along with language costs, time zones, taxes, and local banking regulations are among the main reasons for these prominence of these centers. So these offshore centers try to strip down and greatly reduce the regulations and the requirements of doing business by using these offshore centers to help facilitate companies' lower cost of transactions and regulations in dealing with the inflow and outflow of income and profits from their international operations. Sometimes they're known as tax shelters. Okay. So the U.S. dollar continues to dominate the global financial markets. It's the currency, it's the de facto world currency. So including the currency in circulation in the international bond market, the euro has surpassed the dollar in some aspects of world currencies. Now, so the euro has become more of a challenge to the dollar, and there's other contenders like the Chinese yuan. Now, the euro is a big currency, but still overall total dollars in circulation, it's the U.S. dollar that still remains the largest of the world currencies. Now, although U.S. banks and the financial institutions continue to play a significant role in the global markets, financial giants from Japan and Europe have become major participants in the euro market of trading dollars and other currencies outside of U.S. control. So if we look at currency operations and translation methods, integrated foreign currency or integrated foreign entity international practice translation method operates as an extension of the parent. So it's primarily a translation tool of the currencies. Self-sustaining financial entity operations independent, so it operates independently of the parent multinational, and the current rate method is the primary approach. Functional currency approach, and this is used by most of the U.S. companies. This is, the dominant currency in which the foreign subsidiary conducts its activities may be the same as the parent's, in which case there's a temporal method is applied. And the subsidiaries, the current rate method, or third currency temporal, then current. So it's really just trying to figure out where you're going to translate your money to. So many of the multinational U.S. companies are going to translate all their foreign subsidiaries back into dollars for their financial statements. Now we look to accounting, specifically FASB number 52, and FASB is the international accounting standards. So the U.S. multinationals first to convert the financial statement accounts to foreign subsidiaries into the functional currency, which is generally U.S. dollars, and then translate all accounts into the parent's firm's currency using the all current rate method. So this would basically say that, of course you're going to be using, if you're an American multinational, you'll be using an American accounting system, and you would first calculate all your financial statements in the foreign currency, then translate them all back into the domestic currency. So the functional currency is the currency which a subsidiary primarily generates and expands cash, in which its accounts are maintained. So let's just take an example. You may have a country that operates that's a United States company that operates in England and Germany. So the functional currency is going to be pounds for the portion of the company in England and euros for a portion of the company in Germany. Now these functional currency, and of course the U.S. operations will operate in dollars, and so you have three functional currencies. Now then once all their books will be done in those functional currencies, all three currencies will be converted into dollars, and there's no conversion for dollars, so just really the pounds and the euro, since those are the foreign subsidiaries and the functional currencies of the foreign subsidiaries. They'll be translated back into US dollars, so they have a consolidated financial statement all in dollars. That would be the basis of how the company would produce its financial ratios and financial statistics. Okay. The all current, now these were talked about before, so they need a little explaining. I mentioned them in this slide here. You might have been thinking, what are these different approaches he's talking about? So this is where I explain them. So the all current rate method is the method by which functional currency denominated financial statements of a multinational corporation's subsidiary are translated into the parent company's currency. So the all current rate method, just basically what I was describing before, all those foreign currencies, all your foreign subsidiaries are all transferred to the parent company. And for the sake of this lecture, we're going to consider the parent company always to be an American company. So they all get translated back to dollars. Then the temporal method is a method that requires specific assets and liability to be translated into so-called historical exchange rates, translated at historical exchange rates, and that the foreign exchange transaction gains or losses be reflected in the current year's income. So basically with this method we would look at the transactions, and when the transactions occurred they would be translated back to dollars, say that day, and then any gain or loss would be recorded as a profit or loss in the income. So we wouldn't wait to the end of the year and translate everything. We would be translating things currently under a standard cost of the currency, or what we call historical cost, to calculate profits and gains established every functional period. So let's look at this. Here's a procedure flow chart for the U.S. Translation process. So, if the financial statements of the foreign subsidiary are expressed in a foreign currency, the following determinations are made. Is the local currency the functional currency? If no, is the U.S. dollar the functional currency? If no, remeasure from foreign currency to functional, the temporal method, and translate into dollars, current rate method. So again, the other, is the dollar the functional currency? If yes, remeasure to dollars, temporal method. Now, is the local currency the functional currency? Yes. Translate to dollars, current rate method. So here's just basically a chart of what do you do in what situations. You just have to know what position your two companies are in to figure out how to properly translate the currency. Okay. So I'm going to stop here, and part 2 of this lecture we'll start to talk about exchange rate risk.